Hi, welcome back again. In this video, I will present three things related to fulfilling the major assignment 2 for course English for Accounting. Okay, let's get started. Major assignment 2 English for Accounting. Direct and indirect costs. Direct and indirect costs are accounting concepts that help you separate expenditures that fluctuate relative to how much business you transact and costs that stay mostly the same, whether you sell one item or 1,000. Direct costs are considered direct because the expense incurred go directly into the product or service you sell. Indirect costs are indirect because they describe items necessary for running your business but not necessarily for producing your products. The most obvious examples of direct costs are the materials that go into producing the items you sell and the labor that goes into creating it. Rent, utilities, and payroll are examples of indirect costs. Example of direct costs. The most obvious examples of direct costs are the materials that go into producing the item you sell and the labor that goes into creating it. If you manufacture clothing, the amount of fabric and thread you use will vary directly in proportion to how many shirts you make. Even if you retail items that another business manufactures, the amount of inventory you purchase will vary relative to how many items you sell. Similarly, you'll pay your employees for a greater number of hours if they make 200 shirts than if they make 20. Example of indirect cost. The rent you pay on your facility is an indirect cost because it doesn't fluctuate to your sales volume. The utilities costs you incur to keep your operation going are considered indirect costs as well because you have to keep your light on and your rooms heat whether your business is thriving or struggling. Payroll for office staff that keeps track of payrolls and indirect costs as well because it goes into general operation rather than specific items that you sell to generate revenue. Direct versus indirect labor. In addition to the labor that goes directly into producing the product you sell, your business must maintain the physical and information system that allow you to do your production work and deliver the end result to your customer. Handling inventory, shipping orders, completing invoice, making sales calls, and writing employee paychecks all generate indirect labor costs that are tracked as part of overhead costs rather than cost of goods sold or indirect costs. These costs don't increase appreciably relative to the volume of business you transact. You still have to have your own clients whether you bake one batch of bread or 10. There will likely be more built up after 10 batches, but it certainly won't take 10 times as long to clean it. Direct expense. Direct costs are expenses that can be easily traced or connected to the items your business produces or the service it provides. Your company's direct material expense are the cost of the consumable things that you need to produce the items your business sells. If, for example, your company makes aluminum cans, the metal you purchase and shape into cans will be consumed as your production continues and is clearly related or traceable to the cans your business produces. As a result, the cost of the aluminum is a direct material expense. Indirect expense, unlike direct costs. Indirect costs are expenses that are necessary for your business but not directly related to your company's production of goods or provision of service. Example of indirect costs are the amount your business pays in rent, the depreciation of your company's equipment, and the property tax your business pays. Variable expense. A variable expense is one that increases and then decreases in concert with your company's production level, meaning it goes up when your business makes more of the items it sells and decreases when your business product fewer units. Since you will generally need to order more materials and pay for increased labor when you increase your company output and purchase fewer materials and cut back on your employees' hours when you slow production down. Your direct labor and direct material costs are variable expense. Fixed expense. Similar to how direct costs are intimately related to variable expense, indirect costs are interrelated with your company's fixed expense. Fixed, as, fixed expense are the costs your business incurs that are not dependent on the number of sellable units your company makes, meaning your fixed expense will be the same regardless of whether your business produces 10 units or 1,000 100,000 pieces. Examples of fixed expense include loan payments, insurance premium, and management salaries. Investment in stock market. Stock market. The stock market refers to public markets that exist for issuing, buying, and selling stock that trade on a stock exchange or over the counter. Stocks, also known as equities, represent fractional ownership in a company, and the stock market is a place where investors can buy and sell ownership of such investable assets. An efficiently functioning stock market is considered critical to economic development, as it gives companies the ability to quickly access capital from the public. Purpose of the stock market. The stock market serves two very important purposes. The first is to provide capital to companies that they can use to fund and expand their business. The secondary purpose the stock market serves is to give investors, those who purchase stocks, the opportunity to share in the profits of publicly traded companies. Investors can profit from stock being in one of two ways. Some stock pay regular dividends, a given amount of money per share of stock someone owns. The other way investors can profit from buying stock is by selling their stock for a profit if the stock price increase from their purchase price. Stock market players. Investment banks handle the initial public offering of stock that occurs when a company first decides to become a publicly traded company by offering stock shares. Shares offered in EPOS are most commonly purchased by large institutional investors such as pension funds or mutual fund companies. Stockbrokers, who may or may not also be acting as financial advisors, buy and sell stock for their clients, who may be either institutional investor or individual retail investor. Equity research analysis may be employed by stockbroker firms, mutual fund companies, hedge funds, or investment banks. There are individuals who research publicly traded companies and attempt to forecast whether a company's stock is likely to rise or fall in price. Fund managers or portfolio managers, which includes hedge fund managers, mutual fund managers, and exchange fund managers, are important stock market participants because they buy and sell large quantities of stocks. If a popular mutual fund decides to invest heavily in a particular stock, that demand for the stock alone is often significant enough to drive the stock's price noticeably higher. Analyzing stocks. Price to earning ratio. The ratio of a company's stock price in relation to its EPS. A higher price to earning ratio indicates that investors are willing to pay higher price per share for the company's stock because they expect the company to grow and the stock price to rise. Debt to equity ratio. This is a fundamental metric of a company's financial stability as it shows what percentage of a company operations are being funded by debt compared to what percentage are being funded by equity investors. A lower debt to equity ratio indicating primary funding from investors is preferable. Return on equity ratio. The return on equity ratio is considered a good indicator of a company's growth potential, as it shows the company's net income relative to the total equity investment in the company. Profit margin. There are several profit margin ratios that investors may consider, including operation profit margin and net profit margin. The advantage of looking at profit margin instead of just an absolute dollar profit figure is that it shows what a company's percentage profitability is. Two basic approaches to stock market investing. There are countless methods of stock picking that analysts and investors employ, but virtually all of them are one form or another of the two basic stock buying strategies of value investing or growth investing. Value investor typically invest in well-established companies that have shown steady profitability over a long period of time and may offer regular dividend income. Value investing is more focused on avoiding risk than growth investing is. Although value investors decide to buy stock when they consider the stock price to be undervalued bargain. Growth investors seek out companies with exceptionally high growth potential, hoping to realize maximum appreciation in share price that are usually less concerned with dividend income and are more willing to risk investing in relatively young companies. Technology stocks, because of their high growth potential, are often favored by growth investors. Roles of accountant in globalization era. International accounting is complex because of its nature being linked to the globalization movement that is sweeping all economy. However, the globalization is affecting in accounting craft, standards, management, audit, and tax. Besides, the role of accountant in particular has become more important, not only in the corporate level, but also at the national level and even more importantly in the international level. The roles of the accountant in the era of globalization is divided into main sections. The first part discusses the definition of management accounting and its features. The second part discusses the globalization and its features. The third part focuses on the role of the accountants. The fourth part seeks public perception towards the accountant. Strategic management. Goodstein, Nolan, and Pfeffer define strategic management as the process by which the guilding members of an organization envision its future and develop the necessary procedures and operations to achieve that future. Susan suggests a guide to the strategic management process as following: agreement on initiation of the strategic management process, identification and clarification of the organization missions, objectives, and current strategies, identification of the organization's internal strengths and weaknesses, assessment of the threats and opportunities from the external environment, identification of key constituents or stakeholders and their expectation, identification of the key strategic issues confronting the organization, design or analysis or selection of strategic alternatives and options to manage issues identified, implementation of strategy, and monitoring and review of the strategy performance. Performance management. Improvement and Development Agency defines performance management as taking action is in response to actual performance to make the outcomes for a user and the public better than they would otherwise be. So, in short, we can say that performance management is the outcomes of work. Performance as defined above is affected by a number of factors. Armstrong and Barron state the following five factors: personal factors, leadership, team, system, and contextual or situational factors. The management accountant within the organization. Management accountant used to work in the accounting department. Additionally, they used to report to the controller, who is responsible of their financial accounting, managerial accounting, and tax reporting, and he or she reports directly to the chief financial officer, who is in return charge of all the organization's financial officer and plays an important role in overseeing the organization's financial matters. Nowadays, management accountants is located throughout the company and works in the cross-functional team, which consists of employees presenting various functions of the organization, such as research and development, design, production, marketing, distribution, and customer service, and they report to the Vice President of various operations. Bamber et al. 2008. Managerial accounting. Managerial accountants add value to their organization by pursuing five major objectives. Hilton 2004, which are 1. Management accountants add value to their organization by helping the top management in decision making and planning. 2. Management accountants add value to their organization by helping the top management in directing and controlling the operational activities. 3. Management accountants add value to their organization by achieving the organization goals by motivating all the employees, including managers, toward the organization goals. 4. Management accountant add value to their organization by measuring the performance of activities, managers, and other employees within the organization. And the last, management accountants add value to their organization by estimating the organization's competitive position. Thank you. Okay, those are three things that I present. Hopefully this is useful. Thanks for watching this video and see you.